You can win most of your trades and still lose money. 70% win rate, and your account is down. That shouldn't be possible. If you're right more than you're wrong, you should be profitable. That's what we all believe. But here's the part nobody says clearly. Win rate doesn't decide if you make money. Structure does. And before this ends, you're going to see the one number that actually determines whether your system survives or slowly drains your account. I learned this the hard way. I had months where I felt consistent, clean entries, high accuracy, lots of green, but the equity curve kept sagging. And that contradiction is dangerous, because when you're wrong often, you know there's a problem. When you're right often and still losing, you don't know what to fix. So you tweak entries, add indicators, change time frames. None of that touches the real issue. Let's simplify it. 100 trades, you win 70. Average win, $100. Average loss, $300. 70 wins gives you $7,000. 30 losses takes $9,000. You were right most of the time. You still lost $2,000. No drama, no meltdown, just imbalance. Small wins, bigger losses. And the dangerous part is this doesn't feel broken. It feels stable, because most trades close green. Your brain measures frequency. The market measures magnitude. That mismatch is where accounts shrink. Think about this carefully. If your average loss is 3 times your average win, your system demands near perfection. You must keep winning. You must maintain accuracy. You cannot afford normal variance. And variance is not optional in trading. Losses cluster. Streaks happen. Even strong strategies go through drawdowns. If your structure cannot tolerate being wrong multiple times in a row, it will eventually collapse. That's why high win rate systems often look amazing in short samples. They feel smooth until 1 week resets everything. Now compare that to a system where you risk 1 to make 2. You lose 3 trades in a row. You're down 3R. 1 clean winner brings back 2R. 2 winners and you're positive again. That's resilience. Resilience is more important than accuracy. Let that sink in. You don't need to win often. You need to survive long enough for your edge to play out. That's expectancy. Not a buzzword, just average outcome per trade over a large sample. Win rate multiplied by average win minus loss rate multiplied by average loss. If that number is positive, your system grows over time. If it's negative, it decays over time. It's that simple. And here's the uncomfortable question. Do you actually know your expectancy? Not your win rate, not your biggest win. Your real average win and average loss across at least 50 trades. Most traders don't. They know how often they're right. They don't know if their math works. And that's backwards. Let me compress this into something you won't forget. Trader A wins 70% of the time, makes 150 when right, loses 400 when wrong. Trader B wins 40% of the time, makes 300 when right, loses 100 when wrong. Trader A feels consistent. Trader B feels wrong a lot. After 100 trades, Trader A loses. Trader B grows. Same charts, different math. This is where the identity shift happens. Being right often is not a trading goal. Positive expectancy is. And expectancy comes from asymmetry. Your winners must meaningfully outweigh your losers. Not slightly, meaningfully. If you risk 1 to make 1, you need to win more than half the time. If you risk 1 to make 0.5, you need to be almost perfect. If you risk 1 to make 2, you can be wrong half the time and still grow. If you risk 1 to make 3, you can be wrong more than you're right and still be profitable. That's structural freedom. But it only works if you stop interfering. The moment you widen a stop because you believe in the setup, you increase average loss. The moment you cut a winner early because you're afraid it will reverse, you reduce average win. Both actions destroy expectancy, quietly. Over dozens of trades, tiny emotional adjustments change the entire distribution. So here's what to do. Open your last 30 trades. Ignore the win rate completely. Calculate two numbers: average win, average loss. Now divide average win by average loss. If that number is below 1, your system requires high accuracy just to survive. If it's above 1.5 or 2, you've built breathing room. That breathing room is what keeps accounts alive during drawdowns. From now on, before you enter any trade, ask one question. If this wins, does it pay for at least 2 losses? If the answer is no, you are relying on accuracy, not edge. Accuracy feels good. Edge compounds. When you shift your focus to expectancy, losses stop feeling personal. They become part of distribution. You stop chasing a perfect week. You start managing a long sample. And that's when consistency actually begins. Win rate feeds your ego. Expectancy feeds your account. One gives you short-term validation. The other gives you long-term survival. Choose the one that compounds.